Good morning, everybody. We're just waiting for a few people to join us. So we'll wait a couple of minutes before we get started. I know that a lot of you, we met again at the AccountX webinar, which is our 5th year at AccountX, and it was a really busy one. Anybody that went on the Wednesday I couldn't believe the numbers that were coming through, but it was definitely a good event. So thank you for joining today. Today we will be going through our latest webinar series, and this series is specifically for accountants working with self-employed and limited company directors, so mainly for those practice accountants of you. And in today's webinar, I'm going to be providing a general overview of the lender market. Also going to be dialing in on specific client types and how the market supports them, and hopefully just explain a bit about why and how you might help your clients during the process, and those clients that are struggling to get finance, answer a few of their questions and understand the market in a little better way. Bit of housekeeping, we have got a Q&A for questions. My team will be monitoring the chat and all the questions. I'll answer them at the end, but if you put them in, if you're anything like me, you forget what your question was by the end of the webinar. So if you have a question, pop it in the chat as we're going along, and then at the end of the webinar, I will answer all the questions. Then. So let's get into it. Okay, so a bit about the residential mortgage market. So we're specifically looking at the residential mortgage market first. We will touch on the buy-to-let market for limited company directors, but rather than looking at the resi market and the buy-to-let market, we're specifically thinking about sole traders, the self-employed and the limited company directors, and what the options are available to them. Now, as an overview, residential mortgage market, we've got access to 140 lenders. And the way that those lenders are broken down is into, we like to think, 3 camps. We have the high street, we have building societies, and we have those specialist lenders. Now, if I asked most self-employed people who would they go to for a mortgage, a lot of them would maybe go to their high street bank. A few of them might shop around online on the portals. But some of them will come to you guys and ask for some recommendations on how to get a mortgage, and hopefully that will, by the end of today, you'll know exactly how to answer that question. But just to sort of break down the different types of lenders there. So the high street are doing with high volume. So generally they're going to be a computer says no scenario. Computer says yes, hopefully, but a computer says no or yes. So they do high volume. They've got very strict criteria, but it's quite varied. If we looked at the next slide, you'll be able to see that these are sort of lenders that fit into the high street bucket. The Halifax, your Nationwide, although Nationwide is a building society, it's considered a high street lender. Santander, Barclays. Now, all of those lenders in that first column there, they have quite varied different criteria. In a sense, if I walked into Halifax and as a self-employed individual, I'll be asked for my salary and dividends. So I'll ask me my tax calculations, and it will all be based on salary and dividends, as opposed to walking into HSBC and looking at salary and net profit. So you can see, depending on who a client banks with, they could get very unlucky or very lucky, as you'll see as we go on, depending on what their current situation is. So it is a bit of a minefield for clients out there, and they don't really understand how their income is going to be assessed prior to making a mortgage application. The building societies, they are generally they deal with manual underwriting, so they have less applications coming in than the high street, but so generally they have more manual underwriting, and a lot of the building societies will have some unique criteria. Some of those at the end there will do things that the high street definitely won't. But that just sort of gives you, this is just an overview of a few of the lenders. And then you've got the specialist lending market. Now, the specialist lending market, they may get their funds from securitization. Some of them are actually getting their funds from the high street banks, who are sort of creating funds available for specialist lending. And they are unique in the market in a sense. They'll target certain areas like self-employed and offer unique criteria, like just looking at 1 year's accounts, looking at newly self-employed, adverse credit history, etc., etc. But within all of that, you've got lots of different criteria. So that's where we sort of specialise. We understand the lender's criteria. We don't want clients shopping around and getting declines and all of that, all the pain that comes with that. We listen to the client, understand what their situation is, and then place it with the right lender first time. So let's have a look at those types of clients that we tend to get. So first of all, we'll look at sole traders. Now, income is assessed based on the profit from self-employment for sole traders. Quite simply, we're looking at tax calculations or tax year overviews, as most of you will probably expect. The tax calculation, however, can be no more than 18 months old from the last tax year, which is why generally in October of every year, you may be getting more requests for anywhere between October and December. You may be getting requests saying, look, I want to apply for a mortgage. I need my latest tax return. And you might be saying, well, we've got until January to submit the case. So, and you'll be 100%, we've got until January to submit your tax return, and you're 100% correct. However, the lender market, it's just the information is just too old for them to rely on and to take the numbers if in past September. So they'll look at up to 18 months. So April 2024 April 2025 tax calculation will be valid until September 2026. So we're in May now, so we can still use April 2025. But after September this year, we will need the tax calculations for April 2026 year end. So you'll be getting more requests. So what we like to think is, having those sort of conversations with your clients, are they thinking of purchasing a property, refinancing within the next 12 months is a great question to ask, just so that you can sort of preempt them to say, well, okay, well, and I know you guys all ask for that paperwork really early on, and it all lands on your desk on the 30th of January to get your tax calculation in. But if they are looking to borrow, it's a great question to ask really early on to say, if you're looking to borrow in the next 12 months, then you must have your paperwork in before September, because it could stop you from being able to secure the funding you need or secure the property that you found. Because generally people find a property and then try and sort their finance out. So, which we bang on the drum to say, please don't do it that way, speak to us first, but clients will be clients. So that's just a little bit about the assessment for sole traders and the importance of the dates there. Now, when we're looking at income multiples, they have really crept up over the last, I'd say, year and a half. The government came in with a big mandate to say to lenders, like, we want you to start lending more money. The lenders previously had limits on how much they could lend, which were imposed by the Prudential Regulation Authority, and those limits were removed last year, which enabled lenders to start saying, okay, well, now we can start lending more. So we started to see increases from the 4.5 cap that was in place to 5 to 5.5 to 6 to 6.5. NatWest launched yesterday, and in some cases it can be 7. But when we're talking about the 6 times salary multiples, the 6.5, the 7s, you're really looking at clients with larger incomes. So the 5.5 with some of the high street banks might be 50 to 75. And then 6.5s might be above 100,000, 125, 150, because they've got more disposable income. So generally the bills will be a certain level, and then the higher the income, there's more disposable income, so therefore they could effectively borrow more. So that's why lenders would lend more money to those clients on higher incomes. So that's just on a basic view, as you'd expect. We're looking at sole traders, we're looking at how their income is assessed, and we're looking at tax calculations. But when we're looking at the tax calculations, we're also asking other questions, and those questions might be, well, how could we boost this income? And one of the ways that we can boost the income is looking at car finance. Now, you as accountants might look at their car finance payments and think, well, we can put that into the accounts, and we've already then calculated and used that in their accounts. But because sole traders can only purchase a car in their personal name because they don't have a limited company to put it under, so the car finance is going to be in their personal name. That car finance is going to be on their credit report, and because it's on their credit report, lenders will then factor it in for affordability. So what we can do is we can say, well, you've already counted it in the tax calculations, therefore you've already reduced their profit. So we want to go to a lender and say, look, we've got this car finance, we can prove this, it's already been factored in on the tax calculation, and it could be like £500 a month, it could be £1,000 a month, whatever that figure is, we could factor it back in and boost their income as a sole trader. And we've had clients with some really nice cars who've really struggled to get the mortgage, because you do a great job in ensuring that they're only paying tax on what they need to be paying tax. And it can always it can cause an issue with looking to borrow the amount that they need to borrow. So just an example here, a sole trader on £60,000 would get maybe a multiple of 5 times their salary, meaning that they could borrow £300,000. If we were adding a £500 a month car payment, we could adjust the income to 66,000, and that would give them an extra £30,000 in borrowing. That can make a big difference to somebody looking to either remortgage for a refurbishment, debt consolidation, or a new purchase, a new family home. Okay, so that's a little bit about sole traders there. Next, we're going to look at limited company shareholders. Now, with limited company shareholders, income is assessed either using salary and dividends. So again, we'd look at the tax calculations and tax year overviews for that to look at the salary and the dividends of the business, or salary and net profit. And when we're looking at salary and net profit, we're looking at, of course, the limited company accounts to assess the net profit. Now, when we're looking at the validity of the paperwork, again, we're looking at 18 months, but this is when it can really work, because if you have a client and you haven't completed their account, so let's say we're looking at those in the past September, and we're in October, November, December, and you said, well, I haven't done the tax calculations yet, but their limited company is end of year is December. If their end of year was December, it means that you've actually got until June 2027. So you haven't got to do the tax calculations. We don't just go with a lender that's going to look at tax calculations. We can go with a lender that's going to look at their net profits and their salary plus net profits. So avoiding them for you to wait to have to produce those tax calculations, and they're able to secure a mortgage. So the advantage of looking at both means that we've got options. Now, generally, again, in terms of the multiples, same situation. Higher the salary, the more you can borrow. Now, one thing that happens with limited company directors specifically, they would often get on the phone and say, I'm employed. They'll be quite virulent in saying that I'm employed because I'm employed by my company. So what is the litmus test when we're talking about employment? They're not wrong. Obviously, they are employed by the company, but there's a difference between being employed by your company and the way lenders assess you as an individual, as a borrower. Okay. So different lenders have different criteria when they're considering you to be either employed or self-employed. Now, if you're a very small minority shareholder of a business, i.e. you own 3% shares of a business, you can still be declared as employed. Most lenders, though, to use net profit within the business will be anywhere between 19% and 25% before you could use the share of that net profit towards your affordability. Okay, so that would be the litmus test. So the question we have back is, I completely understand that you are employed by your limited company. However, from a lender's perspective, what shareholding do you have within the business? And therefore you would be classed as a limited company director and shareholder, and therefore self-employed in their mind. And then we would go down the self-employed route. Now, just as we did some add backs with the sole traders, we can also do add backs within the limited company to boost that net profit. Now, one common theme that we see is that limited company directors make pension contributions to boost their pension, but also reduce the amount of corporation tax they need to pay. But they don't have to. So they don't have to do that next year. They don't have to do that the year after. So when we say add backs, we're basically telling a lender, look, they've made this amount of net profit. The reason why the net profit was less this year is because they made a pension contribution. But if we factor that pension contribution back in, their profit would have been this, and that's what's going to happen next year. And that affordability is going to be there ongoing to service a larger mortgage. Another add back is one-off large purchases. So if we see a set of accounts and there's a dip in net profit, we would also look in those accounts, try and understand if there's any been one-off large purchases within the schedule, and if there have been, we'd sort of have a conversation with yourself to ensure it was a one-off, and then position it with the lender that that's not going to be ongoing, and it was only in the last set of accounts. So that's how we can sort of boost that income up. And there's an example here. So 100% shareholder and sole director earning a salary of 20,000, nominal salary of 20,000, and the business is making a net profit of 80,000. From that, paying themselves dividends of 60 and a pension payment of 40,000. Now, let's say, just move this out of the way. Let's say from the net profit plus salary, so salary and dividends, if he was looking at salary and dividends, we would have £80,000 income. So if he walked into a Halifax, he would get, his income would be based on 80,000. If we were looking at salary and net profit, we'd be looking at an income of 100,000. However, if they came to us and we'd look at their accounts and we'd look at their pension payment, we would say, well, we were going to position this particular lender. We want to factor in the pension payment, providing he's not going to be paying that ongoing, and we could boost that income to 120,000. You can see there's a massive difference between walking into a bank and coming out with an agreement in principle of 400,000, as opposed to obtaining a mortgage of with the pension add back of 700,000. So that's £300,000 difference in terms of borrowing capacity. So it's really important to sort of understand what the options are available to your clients. Okay, so we've talked about sole traders, we've talked about limited company directors. Now I would like to talk about contractors. So contractors, of course, they can be employed or self-employed. So these people are maybe IT contractors, project managers, analysts. Even though post IR35, we still see a lot of contractors on a self-employed basis. So that's the area that I'm going to talk about. Now, a contractor on a self-employed basis could come to you and they could be either a sole trader or have a limited company. So they could fall in both of those previous two camps. But in both those previous two camps, the sole trader and the limited company, you're going to be talking to them about any costs that they could apply to the business, and therefore reducing potentially their profits, so to reduce their tax bill, potentially if there are costs associated with their employment. Then when it comes to borrowing, obviously they want to borrow the maximum they can. So what we typically do for contractors is we would look at the contract, and regardless of whether they're paying, that contract is with a limited company or whether that contract is as a sole trader, we can use the day rate figure on the contract, like gross income, like an employed person, and look at the gross income. So that gross income in this example here, let's say the contractor is on £500 a day, so over 5 days a week, we would times that by, now this depends on the lender, we'd be looking between 46 and 48 weeks, allowing for holiday. We would then boost that income to 120,000. 120,000 times 5, give that client £720,000 borrowing. Now that's going to be significantly more than what they would again get if they were just looking at their tax calculations, tax year overviews, or they were looking at the limited company accounts. Now, for contractors, typically they require a 6 months history. However, if you have an IT contractor that's been employed for a long time and they've just gone on to their new contract, there are lenders that we can approach and say it's in the same field, same type of employment. But also you'll find sometimes there are gaps in contracts, and different lenders will have criteria around, we can only allow 1 week, 2 week, 3 week, 2 months gap, and that varies as well. So we sit down with those contractors, look at their contracting history, understand what that looks like, how they're paying themselves, and recommend the appropriate lender for them. So staying with the theme of contractors, what I'd like to do is now look at CIS contractors. So these are those clients looking in the construction industry scheme. So typically tradespeople working on site, and as you'll know, they will get their income deducted at source at 20%. Now, again, they would come to you at the end of a tax year. You'd be then producing their tax returns, and you would be talking about any costs that they have incurred throughout that year, and applying them to the accounts, and therefore their net profit, their profit from self-employment that would be declared on their tax calculations, could be lower than what their gross income. So when it comes to borrowing, they generally can't borrow as much as they wanted to. So the way that we can position CIS contractors is we can actually use their gross income from the pay slips. So some lenders would look at 6 months, an average of 6 months, some lenders will look an average of 3 months, and you can see there's a big difference there depending on the type of year. Sometimes in August people go on holiday, so we might then look at that 6 month average to try and boost it. If they've had a really strong start to the year in January, February, March, then they might want to boost it. In this example, we've got a low first quarter of £2,000 a month, and then a higher second quarter there. So we really want to be looking at a lender that's going to take a 3 month average to annualise the income to 48,000, given a 5 times multiple there. That would give them 240,000. And that's opposed to walking into their bank, and if that was NatWest, they take a 6 month average, they'd walk into NatWest, get a 6 month average, and therefore only be walking out with an agreement in principle of 180,000. So again, it's rather than relying on luck on who you bank with, and are we with the right bank for me, because there's lots of other elements that fall into that. So using the 3 month average, they increase the borrowing by £60,000. Okay, so that's looking at the sole traders, limited company and contractors. Now, I said what I would do is look a little bit around the buy-to-let. Now, normally we do a whole session, whole webinar session on buy-to-let and portfolio, but considering that a lot of limited company directors are using their profits to purchase buy-to-let property, we've got a lot of clients that reinvest their profits of their business by setting up SPVs, special purpose vehicles, limited companies to hold their property assets and moving their profits in. I thought I'd talk a little bit about this today. So when you recommend a client to us, the first thing we're looking at ownership structure. So we're looking at whether the properties are owned within their personal name, whether they are looking at a limited company, so an SPV, whether they're setting up a new SPV. And this is all based on the advice that you give them. So if they're looking at a limited company, if using their trading business to acquire the business, the difference between the two is that there's a lot more lenders on the market that will lend to a limited company SPV, special purpose vehicle, basically because the trading activity of the business doesn't affect their asset. So in an SPV, no trading activity, less risk to lend to that company. Sometimes we're looking at layered companies as well. So that might be a holding company with the trading business underneath, with a SPV to the side, or even an SPV underneath the trading business. Quite often we're working with layered companies when there's friends or colleagues or business partners buying together. They may be using their own SPVs to set up a new SPV, and then the UBOs, they call them, the ultimate beneficial owners, being the clients. So we would look at those layered companies, assess the structure, and then advise accordingly. So whether they're limited liability partnerships, limited company SPVs, trading businesses, layered companies, or obviously purchased in your personal name, there's a market there for them. It's just understanding and the structure, and then being really clear with the lender of making sure we're placing it with the right lender. The second thing, after looking at ownership structure, we'd look at the deposit funds. So the deposit can come from cash, so they could be putting the cash into their business, and if they are, obviously they're creating a director's loan. If it could come as an intercompany loan from another business that they have, so moving the profits over. Some clients like that because they're therefore saving on taking the money out and then paying the dividends there and then. Obviously, there's still a loan between the companies, but we ask the accountants to provide the advice on what's right for the clients in those regards. And then this is one that's becoming more and more popular because of succession planning. Now, 10 years ago, I'd say, 10 years ago, this wasn't really a big thing. We did a lot of concessionary purchases, and those concessionary purchases were people who owned a buy-to-let in their personal name. They were getting to a certain age, they wanted to gift the property to a child. Let's say it still had a 50% loan to value mortgage on it. The child could buy the property with no deposit, and we'd take a 50% mortgage, and it would be transferred with no deposit because the equity was in the property. So that was all straightforward. With the rise and boom in clients purchasing buy-to-let properties now inside limited companies, there became a bit of an issue with succession planning. One way that clients do it is by transferring shares of the business. So they would transfer the shares of the business, so they would take the whole company, take shares of the company. So that would be quite straightforward. But we've had an increase in clients who are maybe not parents, but other relatives wanting to gift particular assets from a limited company, or assets within a limited company to a borrower, another to a family member. But another way of looking at that is that sometimes a property is being gifted, but the person receiving the gift is actually a higher rate taxpayer. and they don't want to receive it in their personal, and they want to receive it in the limited company because it's more tax efficient. So we have got lenders that would allow you to purchase with a limited company and have it receive a concessionary purchase where they don't have to put down a deposit, and effectively creates a director's loan. This is how it's been structured in the past, creates a director's loan to the applicant. So on day one, they receive the director's loan and the property tied up in the limited company. So it's a very good structure. The other thing is incorporations. So when we're still doing incorporations for clients, those clients generally have had their properties or been declaring their income as profit from partnerships for a couple of years, and then they're incorporating those properties into a limited company. So that's generally what we've seen, and that the advice that they've had from their accountants is that there's no stamp duty applicable and CGT can be deferred. So that's we're still doing those incorporations. So if you do have clients who want to have that sort of conversation, what we would talk about is what does that funding look like. The first thing we would look to do is to go through their tax calculations, their portfolio, look at the early repayment charges that they might have, and try and time it to make it most cost effective for that incorporation. But because a lot of limited company directors still invest in residential property and commercial property, this is I thought I'd sort of touch on that during this conversation, this webinar today. Okay, so helping your clients prepare for finance. So one of the things is obviously the 18 months rule, which we've touched on. So what I would say is when we're preparing accounts, if you do ask your clients if they're looking to borrow within the next 12 months, you can save yourself stress for the pressure that they put on you, I'm sure, to get the accounts ready within a very short space of time. So it's just a short question that can save a lot of stress later on, and also helps you understand that what the client's requirements are going forward. Highlight pensions and one-off purchases. So if you do feel that you're working with us or with any other broker, I think it's always advisable to sort of talk about those, highlight those pension payments and one-off purchases, because we would generally look for them. Not all brokers would look for them, and to see whether you could boost your client's income and get the size of the loan that your client requires. And this isn't with the final one there isn't with every lender, but just to save yourself going back and forth, if you've done the work, some lenders are requiring that the accounts, when we're looking at using salary and net profit, are actually signed by an accountant and not by the company. Sometimes we see we're signed by accountant and co, rather than having a specific accountant's name. So I would just advise, if that is what you do, then you may find some accounts be sent back to you for individual signature, just to speed things up. So I thought I'd go through a few case studies with you. So the first case study here is a structural engineer. So this client was employed and happily employed, and the company he was working for decided to turn the company from a limited company into a limited liability partnership. Now, they offered him to become a member, which was great. But one of the things, and it was quite a large business, one of the things that they possibly didn't consider was that during that process, a lot of the clients that needed to obtain finance would suddenly go from being an employed contract to being self-employed. And anyone looking to borrow within that first year without being able to show their first year's accounts would struggle to get finance. So we were able to secure this client a mortgage after 6 months. We were able to use his bank statements, previous in PAYE, and a letter from the accountant, positioned it with the lender and in terms of the explanation, and secure him a mortgage. And obviously he was over the moon, having been declined by his bank. So, you know, that's one way that we could sort of support those clients going through a transition. And that's not only clients, you know, employers going to LLPs, but that's also clients just changing from sole trader to limited company. They may not have their first year's accounts yet, and vice versa. So anybody just transitioning, if we could sort of build a picture and help support them. Another case study here was a client that wanted to incorporate their portfolio. So Sanjay and Mary, they owned a property portfolio in their personal names, 14 properties. It's a mixture of apartments and houses all around Essex way. So he was advised by his accountant to incorporate his portfolio, and after spending 2 years declaring the income as a partnership, they approached us to say, right, we're ready to incorporate. So they formed a new limited company. Now that limited company was an SPV. We could apply for a mortgage on the very day it was set up, and which is what we did. And we raised £1.6 million. There wasn't any stamp duty to pay because they were incorporating the business. They met the rules around incorporating the business, and and obviously the deferment of the CGT as well. They originally struggled in trying to find a lender for a number of reasons. One, it was the mixture of leasehold terms that they had. So there is one thing about lending to the client, so looking at whether the client is sole trader or limited company director, but there's a lot of other factors. You've obviously got the credit situation, but you've also got the types of property as well. So different lenders have different criteria. If you've got property with a short lease, which is what this client had, there were certain lenders. So we put some of the funding with one lender and some of it with others, and that managed to incorporate that portfolio for them. So that was a success story. And finally, dentist purchased a new home while simultaneously selling his current home to his business. So this was a dentist that wanted to move, but he didn't want to sell his current home. So effectively like a let to buy. Now, if he was to do a let to buy, so let out my current home and then go and purchase a new property, the new property was 1.1 million, was going to purchase that new property, he would have to pay an additional 5% stamp duty, or that's an additional 55% on top of the stamp duty, in order to carry out that let to buy. Now, his current home wasn't worth as much as 1.1 million. I think it was around 400,000 or 500,000. So we worked with the accountant on this one, and the accountant's recommendation, what we did is we set up an SPV, and the limited company acquired his current home. So therefore, he didn't have a second home when moving. The limited company acquired it, so the limited company paid the additional rate of stamp duty, but only on $500,000. And then he only paid the basic rate of stamp duty on the onward purchase. Now, the advantage of that is that his intention was to keep his current home long term. So in order to do that, he wanted it to be as tax efficient as possible. So that's why he put it into the limited company. In addition to that, he actually moved £200,000 over from his trading business into their SPV, and that's the money that they used to buy the property from themselves, and then that's the same money that they used to then buy the onward purchase, put down as a deposit on the onward purchase. So it was a good transaction, and it's just out of the box thinking in order to sort of save the client's money. I think that's summarised what I just said there. Okay, so access to lenders. So we have access to over 140 plus lenders, as I said at the start. We've got some very good lender relationships as well. They come into our office regularly. We have the events that we sort of put on are well intended by the lenders, and the importance of building those relationships is that he's getting cases through that other brokers can't, and understanding that market. And although you've got your high street, you've got your building societies, but within that there's always an element of flexibility, and if you can position the case correctly, we can generally get cases approved that others can't. So when we're looking at adverse credit, it's understanding that there is a large market out there for people that have had county court judgments, defaults, mispayments, bankruptcies. It's probably a myth that everyone feels that if they've got adverse credit, you definitely can't get a mortgage, because there's a huge market out there for people who have had those sort of bad situations, whether it be loss of a job, illness, divorce, whatever situation, will these life events happen. So there's definitely a market to support those clients. Complex property. So I talked a little bit earlier around the short leases. Now, short leases is one example. We're getting a lot of EWS1 issues on the leasehold flats. We've got people, BISF properties, steel framed properties, concrete clad properties, agricultural ties, barn conversions. These sort of elements that would all come into this sort of complex property. So it's not much we haven't seen. So if you have a client who's got a query, I think something that we're finding at the moment is lease and freehold issues. So where they might own a freehold in limited company, or they own it in their personal name, and they've also got one of the leases. So certain lenders will say, well, they have exposure limits on the block. So anything like that, then you can send them through to us, and we can sort of talk them through. Expats, there's a huge market for expats, and there's more and more lenders coming on stream to support that market as well. That's both on residential and buy-to-let. And foreign nationals. So with foreign nationals, what we're looking at is source of wealth. Generally, foreign nationals purchasing in the UK, some lenders will, from investment purposes, will want to see so there's not only foreign nationals, there's foreign nationals and foreign residents. So people living abroad wanting to acquire in the UK. So generally, you'll be looking at a 25% deposit, and so some lenders will require you to have a limited company set up as well. So, but if you've got a client overseas looking to acquire, main thing is source of wealth. We can understand the source of wealth, then generally we can place the case. So, why accountants partner with us for complex finance queries? One, we're experts in complex cases. I hope we've given you a bit of an overview of what we do differently there for your self-employed clients. Query to keys, we own it. So whether from the initial inquiry all the way through to completion. So we don't just stop at giving you a mortgage offer. We've got an admin team that take your clients all the way through to completion. So really hold your client's hand through the process. Same day advice. If you send over a client to us, we will get back to them same day and provide an indicative quote, so they've got an idea of what they can do. And for some of those accountants that are looking for commission, we also can do a commission split and offer you a commission split there. The QR code that's on screen right now takes you to our introducer page. So I think Claudia's also popped it in the chat as well, so you have access to it there. Thank you, Claudia. A little bit about us at Home Mortgages. We're a team of 19 advisors and admin staff. We service approximately 30 accountants currently, and what we're very, very proud of is our customer service. I'm really happy with that, because the last webinar I did, it was 1,650, so we're now at 1,723 five-star reviews and counting. So if you've got a client and you want to put them with a company that's going to look after your client, then you found them. So a few of our five-star reviews there. So do we have any questions? Are there any questions from the sessions? before we go on to questions, so as a group, we don't only look at residential and buy-to-let mortgages. So we'll be running a couple of more webinars. The next one is Home of Insurance by our fabulous Kerry, who's our insurance expert. That's where we'll be going through personal insurance, so that's life insurance, critical illness cover, and business insurance. Now, when we talk about business insurance, we're talking about moving those policies into a limited company. So we're talking about relevant life plans, shareholder protection, and private medical insurance as well. And then property insurance, buildings and contents. Home Specialist Finance. Our team on Home Specialist Finance will look after all bridging finance, commercial development, and any complex buy-to-let as well for those new builds that are looking to exit. The two webinars will be coming up. Keep an eye out in your inbox. So the protection webinar is on the 4th of June. Again, it'll be a Thursday at 12 p.m. and we've changed that date now, so it's no longer the 28th of May. Unfortunately, we couldn't make that date. So it's actually I think it's the 18th of June. But please keep an eye out on your inbox, because we'll be sending out an invite for the commercial and specialist finance webinar as well. Okay, so I'll stop sharing and see if there's any questions in the chat. So, Q&A. Thank you, Paul, for obviously made an error in that. Right, so if a client who has 2 years for visa family and wants to apply for buying a house, is that allowed? Yes, it is. Yep, so we've got lenders that will lend with clients just coming straight into the country. It depends obviously on their occupation and the tier of their visa. But yes, Alba, we can support with that. Suda, so you asked about limited company net profit. So the majority of the market will always look at net profit after tax. Okay, obvious reasons that is the money that they could generally take out of the business to use towards a mortgage. However, we do have a couple of lenders that still will look at pre-tax profit. Okay, there's a slightly premium in the interest rate, but if there's a real boost needed for the amount that you need to borrow, then there are a couple of lenders that still look at gross profit. Don't know why, because the money doesn't exist, but there is. We don't complain. We are able to place those cases as well. So, but yeah, net profit after tax is generally the calculation, but there are a couple of lenders that we can still speak to regarding pre-tax profit. Just see if there's any further questions. Yes, we'll send you the recording out to all the attendees, so you can, if you did miss the beginning, then yep, you'll get to see that. So commission, we pay 15% commission to our accountants introducers for any fees that we receive in terms of broker fees and commission from the lenders as well. And if you'd like to use the link that Claudia's put in for the introducer page, then you can access and just fill in the form, and we can register you as an introducer to us. Okay, so there don't seem to be any further questions. So just want to thank you for attending today. If there's any specific webinars that you'd like to hear from us about, then please let us know. And yeah, we hope to be able to support your clients and yourselves going forward. Thanks very much for today. Bye-bye.